In this week's episode of the Stockscores Market Minutes, I'm going to show you how you can make more money from your winning trades. I'll then do my regular weekly market analysis, figure out if maybe we have another market crash coming. We'll also do a market scan in search of opportunity, and I will look at the day trade of the week on MTSL. So how do you make more from a winning trade? Well, if you have a trade that's working, why not add to the position? There's a tendency for people to only add to their losers. They try to average down, do all sorts of things that are really quite destructive to trading. And I will say, never ever add to a loser. However, if you have a winning trade, something that's working, why not add to the position? The market's proven your analysis right. And if you use good risk management, you can actually increase your position size without necessarily taking on more risk. Now, we call this scaling in, and it means basically adding every time there is a new buy signal that has an entry price and a support price that is higher than the previous entry price. And I'll show you how this works on a chart in just a moment. It's a pretty simple concept. We are basically buying more of the stock on the break of a pullback from the high. And so if we jump over to the chart, this will make a little more sense. So this is a stock on Friday that had a good move and it fit our entry requirements. You can see there's a little pink dot there. That's our action candle. It was breaking from an ascending triangle pattern. So that was the reason to buy it initially. Now the first scale in point was right here, because notice the stock went up quickly and then it went through a little bit of a pullback and then it broke the pullback. So that's a good reason to add to the position. That's called a flag pattern break. What's also important is that the little support price there, the floor, is higher than the previous entry price. And that's why it was appropriate to scale in there. Then we had another pattern break right here. This is also a little ascending triangle pattern break. So we add more at that point, and our new support price is right here, which is basically the same price as the previous entry. Now what that means is that entry number one at point number two, at entry number two, was profitable. So this trade was profitable at point number two, and trade number two was profitable at point number three. We are adding when we can use the profits from previous entries to mitigate the risk. Now in this particular case, the stock went on a parabolic move to the upside, and then we had a sell signal right there when we broke the parabolic upward trend. So position one makes 17 RR, position two made about 12 RR, and position three made about 7 or 8 RR. And so by adding to the position, we more than doubled our total profit without actually taking on extra risk. And that is what scaling is all about. All right, now let's get into the analysis of the US markets. And as I always do, we'll start off with the S&P 500. Symbol SPY is the ETF. I like to start with the short-term chart first. This is the 30-day, 60-minute chart. And let's figure out if there's likely to be more of a market crash in the near term. So what we want to talk about first is the break of the upward trend line that happened last week. And if you watched last week's video, you will remember that I said, well, that's a negative thing. However, we still have support on the daily time frame, and that daily upward trend, because it was intact, I felt like the market would bounce back this week. And that's exactly what it did. On Monday, it opened weak, and then it moved up, and we finished the week higher than the previous week's close. So far, so good. However, what we see on Friday is that there is a breakdown through this little support level from a falling top. So the short-term signal for the market is actually negative going into next week. Now, it's not extremely negative, but it does look like we could see lower prices on the S&P 500 starting early next week. Now, before we get too concerned, let's take a look at the longer-term daily chart to see what has to hold up. This is the weekly time frame, and you can see that we have held the upward trend line. If we start to break down through the upward trend line, on the daily chart, this is actually the weekly, but watch that daily chart, then we're going to need to get more defensive because the market hit a new high here and then it made a falling top there. So if next week we start to break the daily time frame upward trend line, or we close the week below this upward trend line, somewhere say below 300 on the SPY, then I fear we could see another round of aggressive selling, which would be very profitable for short traders, for short sell traders, and certainly something to pay attention to if you are long of stocks. So if you are long of US stocks, when I say long of, I mean you're an owner of them, you have been a buyer of them, I would be cautious going into next week. No reason to sell yet, but we do start to see some negative signals, and if those accelerate to the downside next week, then I want to be aggressive on taking profits on existing positions, not take too many new positions, and then also look for short selling opportunities or perhaps buy inverse ETFs. All right, moving along to the Russell 2000 ETF. This is IWM. And this is where we can see a bit clearer the upward trend line that we want to watch. So there is the daily upward trend line, and we are making a little falling top here. If we break down through that upward trend line early next week, or anytime next week for that matter, then we're going to want to get defensive. So far, the market's still healthy, but it is starting to show some issues. All right, moving along, this is the Canadian market, and we'll basically see a very similar situation where the Canadian market upward trend line was broken. We bounced back this week, but we're starting to test some support there as well. Now, we haven't made the same breakdown that we saw on the US side, so Canadian market actually looks a little healthier still, but I think you want to be watchful if we start to break upward trend lines on those longer term time frames. We're going to want to get a little bit more on the sell side than we have been over the last few months. And here on that longer term chart, you can see that we've got pretty good support there, but if we start to break down through 22.50 into the $22 range on the T.XIU, then get defensive. All right, coming along here, this is the TSX Venture, still very strong. We had a little bit of a breakdown last week, not this current last week, but the one previous. And I was a little concerned about that, but it was from a new high, so it wasn't a big deal. And now it looks like we're just going to sort of build this little sideways pattern, basically at resistance. So the micro-cap stocks in Canada still holding up reasonably well. On to currencies, and we'll take a look at the US dollar, which is relatively stable, has support. I don't think there's a lot to discuss here. It's basically a sideways market on the US dollar. The Canadian dollar is trying to make a comeback after some pretty strong selling in March, and it's slowly inching its way back into that trading range. I think it probably slowly drifts into that range, but it doesn't look like it's going to go sharply higher anytime soon. On to the interest rate chart. Of course, we always look at the bond market ETF, and if this is going up, then the inverse is happening to interest rates. That means interest rates are going down. And because we've generally in an upward trend on this chart, you can see the upward trend line there, interest rates have been moving lower. However, there is broadening volatility, so that means that the market is uncertain about what will come next. So for now, I see no real reason to think that interest rates are going to start to climb, but I still think that the market has a lot of uncertainty, and therefore I don't think there's any harm in locking in debt at low interest rates now rather than wait for even lower rates, because I'm not sure we're going to get a whole lot lower. On to commodities. Gold looks like it could break out after going sideways for the past couple of months. It's starting to pick up a little bit again, so I'm getting more optimistic that gold will continue its long-term upward trend. Oil has been, I would say, drifting higher. It's not so much that there's strong buyers. It just seems like the sellers have gone away. We're in this slow upward sloping channel. I think that will continue. We've got a little bit of resistance there, but we're starting to break through that. So I expect that oil will continue to drift up as long as this upward trend line isn't broken. And finally, the fear chart. We had a little pickup in fear over the last 2 weeks, but it's still relatively stable, but certainly elevated from where it was. We're obviously a lot higher. And I think that that's the market's recognition that there's still a lot of uncertainty in the world about the future economic environment, and therefore people are buying insurance through the short-term futures of the volatility index. All right, let's just give our ratings then. So US and Canadian stocks, I'm neutral on both time frames. Gold back to bullish long-term, neutral short-term, although that could turn bullish short-term on gold if we do get a breakout. Oil, bullish, it should be neutral long-term for oil and bullish short-term. It is a market that is, as I said, drifting higher, and I think it will continue, but the long-term picture has still got lots of overhead resistance to deal with. So the buyers, last week you could really feel that they're showing less motivation, and that may just be a little bit of a pause in the upward trend, but it could also be the start of a reversal. And so we really need to watch for a break of those upward trend lines from a falling top. Now, gold may soon break out of its sideways trading range that it's been in for a couple of months, so watch for that. Oil, as I said, continues to drift higher. It's not really that it's particularly exciting, but it's more that prices are stabilizing. And in many ways, oil stocks haven't really kept up with the bounce back in oil prices. And so I think that that could start to happen. You may see some opportunities in the oil area. We've mentioned a few of those in the last few weeks, so watch for that. And fear is still relatively elevated. All right, so let's get into the Stockscores market scan now. And what we're going to do is jump over to the Stockscores website and just run a market scan. So here we have the Stockscores site, and I have pulled up the Abnormal Breaks US market scan. Now, this particular scan looks for stocks on the US markets that have made an abnormal move to the upside with some other requirements. And we're also going to limit our search, just to keep the search a little shorter, to stocks at least $1, because sometimes we get, penny stocks coming up. I'm going to avoid those today and run the scan. So I just click on Run Market Scan. It goes through every stock listed in the US, and we'll take a look at maybe a couple pages worth here, see if there's any good opportunities. Now, just because a stock is found with the scan doesn't mean it's good. We still have to apply basic chart pattern recognition, the sorts of things that I teach in the investor course on Stockscores. Here we have a stock breaking out of a little sideways trading range with very abnormal volume, very abnormal price. Those are good things. The issue is there's quite a bit of resistance up here. And so from a risk reward standpoint, I don't see enough upside to really justify the trade there. If you own this stock, I think it looks good, but I don't feel it's a great time to be a buyer of that stock. And so this is the process. We cycle through the charts looking for good chart patterns. When I see something I like, I stop. I take a look at the risk reward trade-off. So here we have YCBD, which is breaking up from a little rising bottom. You can see the volume picked up a little bit on Friday. The Stockscores spiked higher, and we're getting a break from what's called a pennant pattern. That's a pretty good chart. I'd give this, if I was to rate it out of 10, a 6.5 out of 10. Let's see if we can find something a little bit better. This GLG looks quite good. You can see, for those of you that know what chart patterns are all about, you can see there sorry, that didn't draw quite the way I wanted to. That is a pennant pattern again, spike in volume, spike in price. That shows us that investors are excited about something with this company. I'd give this chart a 7 out of 10, which essentially means I believe it has a 70% chance of moving higher. EDNT, I like this as well. I'd give this a 7 out of 10. Looks pretty good. Moving along, we'll look at a couple more here. Let's look at one more page. Why not? It's the weekend. I can spend a little more time cycling through charts looking for predictive chart patterns. You'll notice that I'm zooming past a lot of these, and that's because they just, they're good hold, but they're not necessarily stocks that I would buy today. And I don't really see anything else so far. AHPI is decent. This was actually a pretty good day trader last week as well, but it's breaking a downward trend line and a little bit of a rising bottom starting to come, a little bit of a pickup in volume. I'd give this a 6.5 out of 10. All right, let's jump back into the presentation and look at the day trade of the week. Now, normally when I do day trades, I will often use the 2-minute chart. But the 2-minute chart is pretty fast, and not everyone has the ability or the desire to make those really fast trading decisions. So this week, I thought I would trade off of the 13-minute chart. So this is a stock that triggered a 13-minute action candle on Friday. Now you might wonder, why 13 minutes? Well, I like the 13-minute time frame because there are 30 13-minute segments in a trading day. A trading day is 6.5 hours long. 13 times 30 is 390 minutes, which is 6.5 hours. So it's just a nice even disbursement of 13-minute candles through the whole trading day. So let's take a look at this chart. As you probably know, if you watch my videos every week, I'm always looking for action candles, which is my proprietary indicator. And there was an action candle there, and it was breaking from this boring sideways trading. Nobody cared about this stock. And then it came alive about an hour after the market opened on Friday. Notice also the spike in volume. So we have volume increasing, price action increasing, and with the power of a computer and my action candle indicator, you can find these stocks before most people do. So in this case, using our risk management, for $100 of risk, we would buy 990 shares, which represented $1,260 of capital required. Because this stock is under $3, most brokers won't let you margin it, so you have to put up all $1,260 for this trade. It ended up closing the day at about 4.9 RR, which is a multiple of risk. So that's what these lines are here. These are all risk-reward lines. And so we closed the day right there just below the fifth line. That meant a $490 gain on a $1,260 position, which was a 39% return. And that is pretty awesome and not so time sensitive. All right, so that has been the Stockscores Market Minutes for June 22nd. Hope that you've enjoyed it. Please, if you have, click on the like button, leave a comment, and most importantly, subscribe to the channel. And next week, make sure you trade well.